Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello, and welcome to Business Line's State of the Economy podcast series. This is the third of the podcast, focusing exclusively on the equity markets, and this series on markets is coming to you regularly towards the end of every month. Bringing to you insights from experts on the subject is your host, Parvatha Vardhini. I am the editor of bl.portfolio, Business Line's Sunday feature on investments and personal finance. The expert speaker for this month is Mr. Rahul Singh, Chief Investment Officer, Equities, Tata Asset Management. Mr. Singh, a graduate from IIT Bombay as well as IIM Lucknow, has over 27 years of investment experience. He has previously worked with Standard Chartered Securities and Citigroup Global Markets India as Head of Equity Research. Welcome, Mr. Rahul Singh, to the podcast. Very nice to have you.
Thank you. Very nice to be on your podcast.
This series on markets, you are our third guest, sir. So very interesting times for markets today.
Yeah, exactly. I think we are seeing a lot of risks also in the market at the same time, a lot of growth opportunities. So it's a good balance between risk and reward, I would say, at this point of time.
Okay. I thought this is a very good starter for the conversation. So I was going through your newsletters, which is out in your website. So the last one was put out in June 23. It's titled From the CIO's Desk, I guess. So you had talked of India being in a sweet spot. You had drawn a quadrant and said, China's recovery is slow and there's only a shallow recession in the developed markets. So actually, India is in a sweet spot. So how do you see the scenario today from when you wrote it? Have things changed a lot, or does it remain the same?
It remains the same. In fact, it's gone the other way in the sense that instead of a shallow recession, what we are seeing in US at least is that there's hardly any recession. So we saw that the GDP growth rate is above 4%, comfortably above 4%. Obviously, some of it could be because of inventory stocking and all that. But the point is that there is hardly any recession. So, I think that increases the risk in some ways because the interest rates are likely to remain higher for longer. And also, it will result in slightly higher input prices or commodity prices. So, it's not exactly a best situation from an Indian market perspective. But overall, I think everyone is still of the view that this is a temporary kind of respite before we see actually the GDP growth numbers coming down again in US. China anyway is a slower growth and European region is anyway on a slower growth trajectory. So it's only the US which is right now bucking the trend. And the only other equation which has entered this whole sweet spot, which is negative for India, is what happens to food prices if the geopolitics really flares up. So I would say at the margin, things have turned very slightly negative from a complete sweet spot scenario. We are not in a completely sweet spot scenario. We are slightly away from that. But still, I think the overall balance is still tilted towards one being positive from an economic perspective.
Okay. So the Indian equity markets have definitely reacted to the geopolitical scenario that you were just talking about, the conflict going on in Israel. So, and there's also this bond yields which has been rising in the US, and you also spoke of interest rates remaining higher for longer. So, yes, you do recognize the risk. So what further downside is there for the markets from here on?
I think the downside is if the interest rates remain high. See, one is it's mostly macro, and it's mostly global macro, which can provide or create a downside. Given that if the interest rates remain high, it's obviously negative for equity valuations across the board. And generally negative for risk assets because you're getting almost a risk-free return of 5% in US. So any risk asset will be evaluated much more stringently, and which is one of the reasons why we still see FII selling persisting in the Indian market despite the economic fundamentals being much better than other emerging markets. So that's clearly the risk factor which can create downside. Difficult to quantify the downside because that's more technical in nature, and that will be a result of how much imbalance there is between domestic flows and domestic inflows and global outflows. So it's hazardous to guess how much downside. But I would say the base case scenario for me is that market remains sideways or consolidates at these levels for some period of time, which I think will be a healthy thing to happen if that.
Okay. So, by saying that it's a healthy thing to happen, you mean that there is some kind of a slight overvaluation currently, which will get corrected? What is your view on current valuations?
It's more to do with the fact that if that healthy balance does not remain, and if we get into a situation where we have too much money chasing too few stocks, we typically tend to create a bubble. So a healthy situation is one where we are able to buy what we want to buy at the prices at which we want to. And that is what I think the current situation or plus minus, minus 3-5% market level mean. And if that kind of extends to next 6 to 9 months, I think it's a healthy situation because we would have formed a good base, a better base for the markets to perform from there on for the forthcoming year, which is fiscal 25. And I think that's what I meant by healthy situation. I obviously, markets are not cheap, but they are not in a bubble either, or they are not in a zone where I would press the panic button as of now in terms of overvaluation.
Okay.
So yes, yeah. So Nifty at 19 times is about 5-10% more expensive than the average PE for the last 10 years. So obviously it's not cheap, but it's also one has to remember that the Nifty valuations are higher because of the good things which are happening in the economy currently, which is the revival of the capex cycle, revival of manufacturing as a sector, revival of real estate, banking sector being strong, manufacturing sector being strong, and the corporate sector in general being in a strong situation in terms of a debt equity and leverage perspective. So a lot of combination of factors is resulting in that premium valuation.
Okay. There are suggestions from every quarter today to look at large caps and tread carefully on mid and small caps. So, would you extend this positivity to mid and small caps as well in today's scenario and say that they are still not in bubble zone? Or do you agree with the view that, it is better to look at large caps now?
I think I'll agree to the view that large caps are offering better risk reward at this point of time. Because they have not performed and their growth continues to be pretty decent in a lot of sectors, which includes banks and capital goods, even pharma to that extent. The IT services, which is going through a bit of a uncertain phase, which can continue for the next 6 to 12 months. I think the rest of the sectors and the rest of the large cap sectors are doing fairly well. And valuations compared to mid and small cap have become more reasonable. This is not to say that there are no opportunities in mid and small cap, because what you have to also understand and appreciate is that when the economy moves from just being consumption oriented to consumption plus investment oriented one, there are more opportunities which come up in the mid and small caps as well. Because most of the sectors which are doing well now have not done well over the last 10, 12 years, and now they've started to do well. Predominantly the infrastructure, capital goods, manufacturing, and real estate sectors. And therefore, you will find more companies which are exposed to these sectors in the mid and small cap space rather than the large cap space.
Okay.
So we remain constructive on the small and mid cap space, but obviously in this period of the next 3 to 5 years where we think mid and small cap can still outperform large caps, there would be periods when mid and small cap run a little bit ahead of their time, they consolidate, large caps outperform, and then the mid and small caps catch up. So we've just completed one such phase, I think, where mid and small caps ran very, very hard. And we have reached a point where in the near term, only in the near term, the large caps seem like they are offering better value.
Okay, okay. So you're saying for people with, say, a 3 or 5 year perspective, small and mid caps can still be good picks today in the segments that you were talking about?
Absolutely, absolutely. In fact, we are very constructive, and that's why I said it's a healthy consolidation or a correction which has happened, because it also allows us to buy things or buy stocks which we want to buy at the price at which. I think that's the most important. The last part is the most important part, because if you don't do that and repeat what happened in 2017, then it takes 2-3 years for the returns.
So does this also align with your philosophy, which you've always been indicating in your writings or when you speak? So this is you look at stocks with growth at a reasonable price kind of a scenario, rather than looking at stocks from a value perspective or a growth perspective. So is this in line with the philosophy of the fund house?
Yes, those are the guardrails with which we invest, which is GARP. And we have defined GARP or growth at reasonable price. We have further broken it down into 3 segments. And therefore the entry point of valuation becomes an important call. Of course, if you are investing in a consumer sector and a consumer fund, it is less of a factor. But by and large, for diversified equity funds and for all our funds, growth at reasonable price is the driving force.
Okay.
And that kind of ties up with what we are doing in terms of what we were talking about, large caps being slightly better value than mid and small caps.
Okay, okay. And this philosophy is across timelines, isn't it, sir? So, or is it applicable for today's market condition? You think GARP is the best approach in today's market conditions?
I think it's a timeless approach. The reason sometimes it gets overshadowed by growth or quality is when the interest rates are low and liquidity is ample. Now we saw that period between, say, 2015 to 20, and specifically in 2020 and 21. But those are periods which kind of smoothen out over a 10-year, 7-year horizon. And therefore, I don't see that as a permanent kind of a feature where growth and quality will continue to overshadow valuations for long. And vice versa. So we also don't believe in deep value as a philosophy, because India is a growth market. So we will always look for growth. We will never buy companies or sectors just for the value part of it, or just because they're offering dividend yield. Unless and until we see growth coming back in the sector or the company for whatever reason there might be, we will not buy value for the sake of value. And that's also an important distinction to make. Therefore, I think it's a timeless approach. Specifically for India, I think growth has to be central. So we cannot have a deep value approach because you could have long periods of underperformance on that. And therefore, GARP is a good mix of finding growth at a reasonable value.
So where do you find opportunities, sir, applying this principle today?
So we are seeing opportunities today in power sector, where we think valuations are reasonable, and there is enough and plenty of changes happening in the sector or the demand outlook for us to be positive on certain parts of the power sector. We also see some signs of recovery and valuations being reasonable in the pharma sector. So those are the two, from a sector perspective, these are the two sectors I would highlight. And of course, as I mentioned, that large caps are offering relative value compared to mid and small caps. Within large cap, I would say the large cap banks, large private sector as well as public sector banks are today quite fairly or less than fair value priced as compared to the other sectors when I compare. So these are the 2-3 kind of areas where we are seeing GARP related opportunities in the market.
Great, great, great. So you were talking about the capex theme. So doesn't it seem to have played out a lot of your capital goods, defense, industrials, infra? These stocks have moved up extremely sharply. So, but actually, how is the capex turning out on the ground? Is it as per expectations that have been built in?
Yes, I think so. In some cases, it is even higher than expectation.
Mm, mm,
So it is clearly something which is not just a theme or not just a good thing to talk and write about. It is actually happening on the ground.
mm,
We need to be watchful and see whether any of the drivers of capex slows down, which is government capex, private capex, or real estate, which is the household capex. Till now, we don't see any signs of any slowdown in any of these segments. And even in the order books, when we see of the companies, whether they are in construction or capital goods, is reflecting that positivity. So yes, I think we are continuing to be. I would say we, from an early cycle, we have reached mid cycle, but we some distance before we reach late cycle kind of a situation.
Okay. So you see further upside for these stocks?
Yes, some of the, so again, now here it becomes more of a case to case.
Okay.
When it comes to stock selection, it becomes more of a case to case, because you are right that some of the sectors, some of the sub segments of capex have also run up very hard, like defense and railways. So we need to be selective and we need to be very cognizant of the valuation part, and which is where our philosophy also comes into play and keeps a check on how much risk we should be, because risk not only goes up because of outlook from the earnings point of view, but risk also goes up when valuation.
Correct.
So therefore, we cannot be totally blind to the fact that the risks have also gone up at these values. So we have to be practical and we have to keep balancing our portfolio to the extent that we are not taking excessive risks while remaining positive on these things.
Okay, okay. So in Q1, now the result season is going on. So in Q1, we did see low to mid single digit revenue growth, but then, the PAT growth was very healthy based on lower costs. So what is your reading of the Q2 results so far? And what is your expectation for the rest of the year?
So a good thing is that Q2 results are broadly panning out very similar to Q1. We have seen disappointments in IT, but we have seen solid performance in banking. We have seen good recovery in pharma. We have seen rural consumption not being great, but companies still delivering good profit growth because of the margin expansion. The only change from Q1 to Q2, or rather a slowdown or a disappointment, has been obviously urban consumption, where that continues to slow down. So it's always a mixed bag, and like all the quarters, this is no different. And in the Indian context, it's very difficult to generalize quarter without talking about it individually. And that's really the case. The good part is that despite all the minor disappointments or excitements in the earnings season, the overall profit forecast for fiscal 24 and fiscal 25 is not changing much. It's not getting downgraded or upgraded. It's remaining steady, which is good news, because typically this is an asset test when we come to the middle of the year, and typically we have had years when we have had massive downgrades to the profit forecast. That's not happening this year.
Okay, that's good to hear. So what is your expectation per se for the earnings for the Nifty for FY24?
Yeah, so we are expecting about 15%, 14
Okay.
to 15% growth,
Okay.
and about similar growth in fiscal 25.
Okay. So early part of the fiscal, the consensus was also around 15 to 20%. So you're saying that is intact, like how you explained in your previous response. So there's no need for any room for error because of these global macroeconomic developments.
Well, there is, I mean, it's obviously something to watch if crude prices go up or if commodity prices in general go up. Because one of the saviors for the earnings growth for Indian corporates this year has been that the margins have been supported by lower commodity prices, not just crude, but in general other commodity prices.
Yeah.
And if that starts to change, and that is not just dependent on the geopolitical situation, but also dependent upon if China starts to grow again, then love the commodity. That doesn't seem to be happening. It's not the risk which seems to be real at this point of time, but that can result in meaningful earning cuts if that happens.
Okay, okay. But so far, no reason to worry. That's what you are telling us actually.
Yeah, so far on the balance, no reason to worry. Obviously, there are some sectors which will do worse than expected. There are some sectors which will do expected. But on the balance, when we look at Nifty 50, it is balancing out, or it is canceling each other out.
In the beginning, sir, you spoke about outflows, U.S. interest rates going up and all that. So, how do you see emerging markets per se and India among emerging markets? So, how do you see these things affecting emerging markets, including India, from now on?
So if the interest rates go up, like I was mentioning, the risk assets like emerging markets obviously tend to get outflows, and which is what seems to be happening if you look at the continued FII selling, which is there. How long that continues is a function of what happens to the interest rates in the US and what happens to the US economy. So therefore, when going back to the earlier first question that you had asked about the sweet spot for India would be if there is a shallow recession in the US. Why do I say that? Is if, let's say, a shallow recession means not even a recession, a shallow slowdown, I would say. Recession seems a little bit far-fetched in the US right now. So if from a 4% GDP growth rate, if US drops down to again 1.5% GDP growth rate, that will be ideal for Indian equities, because two things will happen. One, commodity prices will remain under control, and also the interest rate cycle, which seems to be having a risk of upside, will have a risk of downside, in the sense that you might again start to see 10-year bond yields in US drifting down. That'll again be positive for the emerging markets as a space. And once that happens, India will get a slightly higher share of the inflows as and when that happens. Even that as an emerging market, India is doing much better in terms of economic growth rate and the health of corporate and banking sector as compared to the other emerging markets.
Right.
So maybe it takes 6 months, maybe 12 months, but that's the way to go.
Okay. So you expect India to continue to do better than the other emerging markets? That's what you're saying.
That's right. That's right.
Yes, sir. Thank you. Thank you very much for your time, sir. Very interesting insights.
You're welcome. Thank you very much for having me on your podcast, and hope your viewers find it useful.
Sure, sir. Thank you. Thanks a lot. Yeah.